How are you doing, people? Troy here with the Bet Out of That show. We'll be dealing with betting on yourself and getting you on the road to financial freedom. Come here for topics on health, wealth, finance, and self. I'll be having guests from a range of fields to empower you on this journey with me. Make sure you like, comment, and subscribe to the Bet Out of That show.
No, you're right that the call last year that inflation would be well contained and transitory is arguably one of the worst forecasts in Federal Reserve history, that they missed it that bad. They are now stuck with this ultra-aggressive policy because they didn't start raising rates at a very leisurely pace a year ago when they should have done it then. So they got to play big catch-up. They don't intend on creating a hard landing, but what they do intend on doing is reining in prices. I think what people need to understand is, what's the Fed's goal? Lower inflation. What about growth? What about payrolls? What about retail sales? So what? They want lower inflation, and they're going to raise rates till they get lower inflation. How are they going to do that? They're going to slow demand down. And if the stock market wants to go up, that just means maybe they should be talking about 75 instead of 50. That's their mentality right now. And so, yeah, they don't want to create a broken market. They don't want to create a recession. But when you go down that path and you're that adamant about trying to rein in inflation, it makes it very likely that you will create a mistake. And they don't want to create the mistake in the other direction by being too timid right now. That's out the window now. Now they have to get aggressive.
Jim Bianco with some tough words, strong words on the Fed.
Yeah, I think we're all nervous because we said even before the Fed started going from one extreme to the other that this was going to be impossible to safely land this ship. And if you think about the overly accommodative and the dynamics around COVID, but that a Fed that really, pick your spot where you think the Fed really lost their way. It wasn't just 2008, but I'll save that history lesson for another time. What Jim's ultimately talking about is, and he's referring to this Bill Dudley op-ed yesterday where Bill Dudley said if stocks don't fail, the Fed needs to force them. And that's a dynamic that says the Fed targets financial conditions more around the stock market and the housing market. So that's where I'm going here. I hear something about the stock market, and I think we can do a decent job about at least assessing some of the dynamics of who owns what. But when you talk about the housing market, we're talking about the most important asset every person in this country owns, if they own one. And that's the place.
And mortgage rates just went up 50%.
Yeah, well, mortgage rates haven't been this high since 2011. So, and I think of all the knock-on impact of the housing market.
Okay, for as long as he remembers, you bought the dip because the Fed was lowering rates and adding to its balance sheet. If they're going in the opposite direction, shouldn't the market go in the opposite direction?
I agree. Listen, and David Tepper's come on the network for years when the Fed was being accommodative, lowering rates, adding liquidity, said, listen, if you're bearish under these circumstances, you are fighting the Fed. Well, a 180 now from our Federal Reserve. So by definition, if you are bullish overall here, you are fighting that same.
Final quick comment.
And so you really have to look at key metrics when you buy the dip to ensure that the companies that you buy do not continue to keep falling. Those companies have somewhat of a floor, but long term, you'll make a lot of money. What do you say about that, Patrick?
Yes. So what you have to do is, if you're going to buy the dip, make sure you're buying companies that have strong fundamentals in the long run. That's how you're going to maybe protect yourself from this, what I would consider a fairly deep correction in the market. Yeah. And right now, the Fed does not have your back in terms of especially buying those high PE or high PEG growth rate stocks or stocks that don't have earnings.
Right.
Such as your DocuSigns and some of the stocks that are in the ARK Invest. Even though these stocks have great potential, right now it's not to be throwing that kind of risky money towards it. You need to be very defensive And I would just be sticking with some of um, your well-established companies that have less exposure to high valuations, and maybe perhaps by the market per se, like get more, um, buy stocks that closely mimic the S&P 500, because that's going to grow in the long run anyways.
Right. So we're going to look at some of those companies. On this show, we like to provide value and show you examples of what we're talking about here. Certainly, the Fed is working against us in this market, and in the past, the Fed was actually working with us. So
Exactly.
in the past, the Fed, when the market went down, the Fed would do things to make the market go up. In this environment, the Fed is literally trying to punish the market because inflation is way too high. So before, Patrick, we show some examples of this, I saw this little clip on television, and our newer investors would see a clip like this on some of your local financial shows on cable, and they would just instantly jump in these type of companies. And I want to compare this company I'm about to show to like an AMD, what we like. So let me show you this clip quickly. Check this out.
Ideas. Zoom Info is one stock that you like. Is it ZI? Z is in zebra, and I is the ticker symbol?
ZI is the ticker, yes. This is a remarkable company. Just on its face, look at the financials of this company. They grew 50% organically last year with 30% free cash flow margins. What they've done is they've created this proprietary professional information database, and they've married it with applications that make salespeople more effective. And the product basically sells itself. That's why they have the financials that they have. In software, we talk about long-term value to customer acquisition costs. 3 to 5 is considered good. These guys are at 10. So there's a huge opportunity for salespeople to be more effective. Use this in parallel with, Salesforce.com and other applications. But it's truly disruptive and what we look for.
So Patrick, a great company right off the bat. One would see that and say, okay, I'm going to invest in that company. But we need to compare relative metrics to understand if that company is a good deal. One metric we use and we talk about quite a bit is the PEG ratio. And so before we go into comparisons of AMD to like a ZI, Zoom Info, let's get a background. Let's share with our audience what it is, the PEG ratio, and just give them a sense of that so that once I go through the metrics, they'll have a visual and an understanding of that just for our newer investors.
Okay, great. Okay, can you see my screen?
Sure.
So this is an article that is based on from Investopedia, and that's always a good source for investor education. And this article talks about the PEG ratio in a very concise way. So what is considered a good PEG or PEG ratio? The price earnings to growth ratio or PEG ratio is a stock valuation measure that investors and analysts can use to get a broad assessment of a company's performance and evaluate investment risk. In theory, a PEG ratio value of 1 represents a perfect correlation between the company's market value and its projected growth rate. PEG ratios higher than 1 are generally considered unfavorable, suggesting that the stock is overvalued, that is, especially in this high inflationary environment. You might want to take a closer look at that. Conversely, ratios lower than 1 are considered better, indicating a stock is undervalued. So, again, in this high inflationary period, you want to kind of hoard those kind of stocks if you're going to be using this PEG ratio. However, These are the key takeaways I want the audience to go with. The price earnings to growth, or PEG ratio, is a valuation metric used for stocks. PEG builds on the PE ratio by considering expected earnings growth rate and not just current earnings. A PEG ratio of under 1 can indicate the stock is undervalued and a potential buy. A PEG ratio above 1 can indicate an overvalued stock, and a PEG ratio will vary based on earnings growth forecast and the time frame being considered. And the benchmark is for the growth rate, it's about 5 years.
Let's go down. Let's keep going down, Patrick.
Okay.
And let's go to here. Yes.
Yes. Okay, so one tip to consider is that the PEG ratio will differ if you use the trailing PE versus the forward PE. Be consistent and aware of which version you use. And we use the forward PE in all intents and
Absolutely.
purposes.
Yeah, so for our audience, that's what we use, the forward PE. And that's what we'll be going through today.
Yes. So how do you calculate the PEG ratio? And essentially, the way you calculate the PEG ratio is you first got to look at the PE ratio and calculate it. So that's obviously price of the stock divided by the earnings of the stock. That will give you a PE ratio. And then you take the earnings growth rate over 5 years. And then that would be your EGR here. And then you divide this PE ratio by the expected or earnings growth rate over the next 5 years.
Yeah, so Patrick, you really don't have to calculate the PE. The PE is given to you, and we'll show that. And the PEG ratio is given to you as well. So you do not really have to calculate any of this stuff. But it's good to know where it comes from. But what is the general message behind this? And what is all of that trying to say? Essentially, what that is saying is, if your company expected growth rate, let's say your Apple, is expected to grow 30% over the next 5 years, then you should not be paying for a stock with a PE ratio over 30, right? That's what it's saying. Make sure the PE ratio for the company that you're buying is equal to the expected growth rate 5 years for that company. That's it in a mouthful, right? That's in a nutshell what that was saying.
Exactly.
But certain industries have different certain PEG ratios that are acceptable. For instance, tax companies, tech companies like Apple and AMD and NVIDIA and those type of companies, the market typically allows a PEG ratio of 2 or less. So anything between 2 and 1 is a good price. Non-tech companies, the PEG ratio should be 1 or less. So there is a curve for tech companies because they grow faster. They have bigger growth, so the market is willing to pay more for it. But in a nutshell, that's what we will be looking at today. And we'll be doing some comparisons between AMD and the ZI company that you saw in the intro just a moment ago. So, and by the way, Patrick, happy Easter. We're live on YouTube for a change and not pre-recorded.
Yes, and happy Easter to you as well. Thank you.
So let's look at, let me share my screen and let's go through a little bit of this stuff that we just talked about in this inflationary market. And let me share my screen here. All right, Patrick. So right now I am in Morningstar.
Yes.
And this is the paid version, $30 per month. We showed you on a past show how to get it for free. So look at the past show and you can see how to get this for free. So here's the Morningstar rating for AMD. Look at that 4-star rating. Now Morningstar is a pretty conservative publication. So if they give 4 stars, that means AMD is priced at a very good stock price right now. So let's look at the fair value where Morningstar says AMD is a good price. And you can see AMD right now is trading much less than fair value at $93 a share. So it's really oversold, right? So that's a good indication that this may be a good stock to purchase. Now, we showed the video for Zoom Info earlier, and kind of the point I wanted to make there, Patrick, is I want our audience to go off and do their own homework when they see companies on television like Bloomberg and CNBC and company. This is kind of the analysis I do to reduce my risk when purchasing stocks. Okay, so I would compare another tech company like Zoom Info, which is kind of slightly different sector, but a tech company. And let's look at the Morningstar rating on it. 3 stars, fair value 60, last close 55. Not as attractive. Okay?
Yes.
All right, so then let's get into some of the metrics that we just went over. I'm here on Yahoo Finance. I am under the statistics tab. We'll go over the analysis tab in a moment, but statistics is, and we do this every show, guys, so we're really trying to hammer the point home here. So let's look at AMD in comparison to Zoom Info. Okay, so forward PE, Patrick. Not sure you can see that. I'm going to blow that up. We pay attention to the forward PE more than the trailing PE because we're trying to predict the future stock price. And again, 24. Now, what did we say about the PEG ratio a little while ago? We want that PE ratio to be equal to the PEG ratio or less. But if it's a tech stock, which AMD is, then 2 or less. And you can see here with the PEG ratio, hey, 1.29, fairly priced for this company in this environment, right?
Yeah, it's in the ballpark.
It is in the ballpark, and it's less than 2. So
yes,
that's not bad. Now, what's good about Yahoo Finance? In Yahoo Finance, this is the free version. Check this out, Patrick. When you look at the PEG ratio here, you can look at the past PEG ratio ratings from past quarters to see the relative price of what you're paying today. And so it's still in that relative ballpark, a good price in comparison to the past. And the stock market has gone down a great deal, right?
Yes,
So
it has.
that looks good. And then look at the price to sales. We have talked about that in past shows. We want that below 10. And so it passes that test. Now let's look at Zoom Info with that fresh in our minds. Let's go here and let's look at Zoom Info metrics here. All right, Patrick. Zoom Info, forward PE. Look at that. You're paying 77 times earnings. Now, one thing I did not mention a moment ago is, where do we want our PE ratio generally in this inflationary environment to be? And that is the number 30, right?
The number 30, exactly.
Yeah. So generally, we want our PE ratio regardless to be 30 or less. And for non-tech stocks to be 20 or less. And then we do this whole PEG ratio thing on top of that. But look at this. Check that out. That PE ratio is 77 times the earnings per share. Relatively expensive, so this company should be growing like a weed. There is NA for the expected growth rate or PE ratio. I'm sorry, PEG ratio. And the reason being, this company is only 2 years old. So there is no 5-year growth that you could compare it to because it's only 2 years old. So you do not have a PEG ratio. So that's another flag, right? Patrick?
Yes.
You have established company like an AMD versus a Zoom Info, which is not as established. I'm going to play it safe in this inflationary environment and go with the more established CEO and company that's been around for a while. You know what I mean?
Yes.
So,
And it's a company that still can grow very, very rapidly.
exactly. So a high forward PE, we cannot compare to PEG. Now, again, price to sales, we like below 10 in an inflationary environment, around 10 or less. Look at the price you're paying for this stock times the sales. 29. Now, just to take you back to AMD, you was paying 7 times sales. So just some markers there. Let me show you some additional markers to be aware of. Let's look at the management effectiveness. We typically want these numbers to be 15% or more. Return on assets and return on equity. AMD passes that mark. I go to Zoom Info, just letting you see, and look at the management effectiveness. So just general markers to let you see the health of a company. Let's look at one last thing, Patrick, on AMD. I'm just letting you know I'm still on AMD here. Let's look at the balance sheet. And so let's look at the income statement, and let's look at the balance sheet here. Let's look at the EBITDA here. And that is the earnings before interest, tax, depreciation, and amortization. This company is making $4 billion before it has to pay taxes and depreciation and all of that stuff, right?
Yes.
And this is AMD.
Yeah. That's money from operations. Yeah.
Yeah.
Very helpful.
AMD has $3 billion in cash. Look at its debt. Only $732 million. It has more than enough money in cash alone to pay off its debt. And its money from operations well exceeds its debt. So it's a very strong balance sheet for AMD. So let's look at Zoom Info. With those things in mind, let's go down. Let's look at the balance sheet. Let's look at cash. They have $727 million in cash. Let's look at the EBITDA, earnings before interest, tax, depreciation, and amortization. Money for operations, $187 million. Cash, 327. But look at the debt, $1.3 billion. So just looking at those type of comparisons, one would be able to say, wow, I can look at this company and take a risk, and this company may turn out to be quite a good company, Patrick. I'm not saying this company is not going to grow, but I think I significantly reduce my risk when I invest in looking at metrics like that in comparison to established, strong companies that have been out there for a while. And for me, I'm leaning more towards an AMD. Now, let me show one last metric here. And let's look at the barchart.com and let's look at the analyst ratings on these two companies. My bad. Before I go there, Patrick, let's look at the growth rates, because there is a reason why Zoom Info is trading for 77 times earnings. It must have monster growth. Okay. So let's look at the analysis for Zoom Info. And let's go and click in here, and let's look at and see at analysis, and let's look at the growth rate. And this is how you find the growth rate, guys, when we was talking about PEG ratio earlier. Here's the 5-year expected growth rate for Zoom Info, where you're paying 77 times the earnings per share, like the PE ratio. Now, let me show you something, Patrick. Let me go to AMD. Let me go to analysis. Let me show you these guys' expected growth rate over the next 5 years. Look at that, Patrick. It's essentially 30% too.
Yes.
With less risk. And the other company, you're paying 77 times the earnings per share to get into that company. Guess what, guys? If I go to statistics and look at the forward PE, you do not pay 77 times to get into AMD. You only pay 25 times. 24.9, which is essentially 25 times. So it's the safer, easier bet. But not just that, Patrick. I'm not finished before I let you jump in. Let me show you something else. Let me show you what bar chart has to say. So, typically what I do before I buy a company and I see this hot shot company on CNBC and it sounds very good, I go off and I do those comparisons, and then I come down to bar chart and see what the analysts have to say. And so you go to barchart.com, you put in the ticker here, and I've already done that for AMD. And then you go down to analyst ratings here, and you click on it, and they will give you the analyst rating for a particular company from 3 months ago and all the way up to current. And so if you look at the current rating for AMD, it's a moderate buy. That's not bad, right?
Yeah.
That's not bad. Let's look at that for Zoom Info. So here's Zoom Info here. I've already done that. Look at it, Patrick. It has a strong buy rating. So Zoom Info is definitely a good growth company. It's just up to you if you're willing to take that risk, if you have the stomach for that volatility that may come with having a 2-year-old company and some of the metrics paying 77 times versus 24.9 times. All right, Patrick, but let me show one last additional thing here. Let's look at the charts, and our established followers would know that it wouldn't be a comprehensive look without a comparison analysis, without looking at the charts. And so here is Zoom Info. So you can see Zoom Info. It goes back to June 2020. So we're just coming up on a year, and it was priced at around $40 a share back then, and now it's at $55 per share. But you only have a 2-year track record, right? And so if I were to go 1 year and then I were to look at our fave, the 200-day moving average, you can see, hey, Zoom is respectable around the 200-day moving average. Let's look at AMD and why I would pick AMD. Okay, so let's go back to AMD and let's go interactive charts again, like we just did there on Zoom Info. And then blowing this up, this is the 5-year chart. And check this out, Patrick. So over a 5-year period, and what we look at, and we talk about often on this show, is where my cursor is pointed. This is the exponential, actually this is the simple moving average, 200 period moving average here. And what you want to see is your stock price consistently stay above this 200 period moving average. And AMD absolutely does that over a 5-year period. So you can see I'm on a 5-year. This is a weekly chart. So again, all of those things go to say is you have to make a decision based on those type of metric. Your thought on that?
Yeah, absolutely. And to me, it's, in my opinion, AMD, you're getting the same level of growth, but you're getting far better metrics.
Exactly. So, I mean, that's kind of what we wanted to show here today is when you're picking stocks in this environment, one might be better just long-term investing in the index. It's going to be choppy for a bit, but if you're going to invest in some of these solid growth companies, make sure you look at that PEG ratio and ensure that your PEG ratio for tech companies are below 2 and your PE ratio is around 30 or less, unless it has crazy growth. That's the point. Thoughts, Patrick?
Yeah, make sure that the if you're going to invest in a company that has a PE ratio of above 30, that it has a strong economic moat, meaning that it's far and wide the leader in its field.
Great point. So we could go to the chat if there's questions out there in the chat. Anyone has any comments in the chat, we can open that up. If you have comments on what we have said today, you can leave us a comment if you agree or disagree. I said a mouthful in explaining all of that stuff there. Patrick, I think you did a good job explaining, what a PEG ratio is. And hopefully we hit the mark with our audience and we did not over confuse them. This is a show for newer and younger investors. So hopefully we hit the mark. We'll see. And leave comments, like, subscribe, and share if you find this content helpful. What would you like to say in closing, Patrick, on this beautiful Easter Sunday?
Yes, this one to wish our viewers happy Easter. Let's have a beautiful day, those who celebrate it, and keep tuning into our show for the best practices in investing.
Yes, and I'll wrap it up, Patrick. We call this show the Bet Out of That Show because when you place a trade, it's called placing a bet, and hopefully it's a winner one to keep you out of debt. And as always, keep investing, and we'll see you next Sunday live on YouTube. Take care.